Boring currency. Live here, and if you've been watching silver, you just witnessed one of the most violent, most calculated takedowns in precious metals history. Silver collapsed an incredible 22% in just 2 hours. It plunged from $90 all the way down to $73 overnight on the Shanghai Futures Exchange. Right now, Western spot is sitting at 75. Western futures are at 76. But get this, Shanghai spot is at 86, and Shanghai futures are still at 90. That means there's a $10 premium still holding in China despite all this carnage. Gold, meanwhile, is at 48.21. Now, if you're genuinely getting value from the content here on Boring Currency Live, please make sure you're subscribed with notifications turned on. After that video I did on JP Morgan's planned manipulation, I got a flood of messages from people saying they were automatically unsubscribed or just stopped getting alerts. That's the price you pay for telling the truth. But we won't stop. Boring Currency. Live will always bring you verified news, clear data, and both sides of the story. Whether this is manipulation or accumulation, we'll keep exposing the full picture. No hype, no greed, no fear, no BS. So let's get into what actually happened, because this wasn't just a market move, this was a war. In the last video, I told you there was no daily close above $90. I've been calling the $87 to $90 zone major resistance for days. It's all documented. We tested it, got rejected, and closed below it 3 separate times. That signaled serious pressure and resistance building up. Our community knew it. We tracked the technicals, the micro, and the macro. We don't gamble. We plan using verified data and solid fundamentals. The copycats out there will probably manufacture another bank crash narrative or some Netflix-level storyline after the fact. But we shared the real-time information as it was unfolding. So what triggered this insane 22% overnight rejection from 90 down to 73? On Tuesday, 3 million ounces were removed from the COMEX vaults. That's not a typo. Nearly 2 million ounces were withdrawn from Asahi, over 900,000 from HSBC, and another 282,000 from JP Morgan. The total COMEX silver inventory dropped to 400 million ounces in a single day. That's a level of drain we haven't seen in years. At the same time, more silver futures contracts were issued for physical delivery, with nearly 100% settlement. Friends, that is not normal. You can't build AI data centers or advanced weapon systems with paper silver. The world needs the real physical metal. Now, contrast that with what happened overnight in Shanghai. Over 1.3 billion ounces of paper silver were traded in a single morning session. That's nearly double the entire annual global mine production, traded in just a few hours. This was not retail investors panicking. This was a systematic paper short selling attack. And yet, despite all of this, silver remained in backwardation, and China maintained its premium over the Western markets. The fundamentals did not break. What we're witnessing is a leveraged system under extreme stress. Futures are being dumped while physical metal is being absorbed at a historic rate. The paper market is completely breaking away from physical reality. And now Shanghai has raised margin requirements and tightened daily price limits. That's not normal market behavior. That's damage control. What just happened to silver? Why did we see a brutal 22% rejection overnight, plunging from 90 to 73? Let's break down the chaos because it's a story of paper versus physical, and the system is showing cracks. On Tuesday, something extraordinary happened at the COMEX vaults. A staggering 3 million ounces of physical silver were pulled out. And no, that's not a typo. We're talking nearly 2 million ounces withdrawn from Asahi, over 900,000 from HSBC, and another 282,000 from JP Morgan. In a single day, the total COMEX silver inventory dropped to just 400 million ounces. We haven't seen a drain of this magnitude in years. This isn't just a number on a screen. This is real, physical metal leaving the building. At the very same time, an unusual amount of silver futures contracts were issued for physical delivery. And guess what? Nearly 100% of them were settled for the actual metal. This is not normal. Why the sudden rush for physical? It's simple. You can't build AI data centers with paper promises. You can't construct advanced weapon systems with a futures contract. The modern world, from green energy to high-tech manufacturing, runs on real, tangible silver. The demand for the physical stuff is insatiable, and the big players are clearly making their move to secure it. Now, let's pivot to what happened overnight on the other side of the world, in Shanghai. This is where the story gets really wild. In a single morning trading session, over 1.3 billion ounces of paper silver were traded. Let that sink in. That's nearly double the entire annual global mine production of silver, traded in just a few hours. This wasn't your average retail investor getting scared and selling off. This had all the hallmarks of a systematic, coordinated paper short selling attack designed to smash the price. A massive wave of selling hit the market, seemingly out of nowhere, with the clear intention of driving the price down. But here's the most fascinating part. Despite this colossal paper dump, the underlying fundamentals held firm. The silver market remained in backwardation, a condition where the spot price is higher than the futures price, signaling tight immediate supply. Even more telling, the silver price in China maintained a premium over Western markets. If this was a true market collapse based on fundamentals, you would expect those premiums to vanish. They didn't. The physical market refused to break. What we are witnessing is a highly leveraged financial system under extreme stress. It's a tug of war. On one side, you have massive futures contracts being sold to suppress the price. On the other, you have an accelerating absorption of the physical metal right out of the vaults. The paper market is becoming increasingly detached from physical reality. The price you see on your screen is being manipulated by paper derivatives, while the real metal is quietly being stockpiled. And how are the exchanges reacting? Shanghai has already moved to raise margin requirements and tighten the daily price limits. Think about what that means. That's not a sign of a healthy, normal market. That's damage control. They're trying to put the brakes on the volatility because they know the system is fragile. They're trying to prevent the paper market from completely imploding. This isn't just another dip. It's a clear signal that the showdown between paper and physical is reaching a critical point. The pressure is building, and the events of the last few days show just how volatile things can get when the system is pushed to its limit. Have you ever wondered what's really going on with the price of silver? Mainstream media might be telling you one story, but the reality on the ground is something completely different. Let's break down what they're not telling you. First, let's talk about price floors. This is a game changer. You see, with paper assets, traders can short them, betting the price will go down. This puts massive downward pressure on the market. But you can't short a physical floor. When a real physical price floor is established, it completely changes the game by taking those short sellers out of the equation. It creates a solid base that paper manipulation can't easily break. While some outlets are quick to mock silver investors, they conveniently forget a crucial fact. Over the past year, silver has massively outperformed many other assets. Yes, we're seeing some wild volatility right now. Deleveraging is happening across the board, and if we dip below certain key support levels, we could see more short-term pain. But it's essential to look past the daily noise and focus on the bigger picture. None of this short-term volatility changes the fundamental story for silver. The structural deficit is real. What does that mean? It means we're using more silver than we're mining, and that gap is widening. The demand for physical delivery is surging, draining inventory from warehouses like the COMEX at an accelerating rate. This isn't just a few retail investors buying coins. We're talking about a significant, sustained physical drain. And who is buying? It's not just the people you'd expect. Major institutions are finally waking up to the reality of the situation. They're starting to understand that their traditional portfolio models are failing in this new economic environment. Even US states are passing legislation to buy and hold physical gold and silver to protect their reserves. They see what's coming. They're looking for real, tangible assets in a world of digital promises and endless money printing. What we're witnessing is a repricing of precious metals based on reality, not on manipulated narratives. The old playbook is being thrown out. The disconnect between the paper price and the physical price is growing wider every day. Think of it as a tug of war. On one side, you have the paper market with its derivatives and algorithms. On the other, you have the physical market driven by real-world supply and demand. And that physical demand is relentless. So when you see these dramatic price swings, don't mistake it for the end of the bull market. Historically, these kinds of volatile shakeouts are not endings, they're beginnings. They are the moments that wash out the weak hands right before the next major leg higher begins. It's a classic pattern we've seen time and time again in bull markets. The tension between paper silver and physical silver has reached a boiling point. The war is on. So where do we go from here? The structural forces are undeniable. The physical drain continues. The institutional and even governmental demand is growing. While the paper market can create chaos in the short term, physical reality will always win in the end. The tide is turning and the true value of silver is being revealed. Keep your eyes on the physical market, because that's where the real story is being written. What a week. The market just threw a massive curveball, and if you're feeling a bit shaken, you're not alone. But let's cut through the noise and focus on what actually matters. Instead of getting lost in the panic, I'm zeroing in on 3 critical signals that will tell us where we're headed next. First, the most important question right now is, can we hold key support on a daily closing basis? Forget the intraday volatility and the dramatic swings. Where we end the day is the real tell. A solid hold above this level would show underlying strength and resilience, suggesting that the big players are absorbing the selling pressure. A break, however, could signal more downside. This is our primary line in the sand. Second, I'm keeping a very close eye on the Shanghai premium. This isn't just some obscure metric. It's a direct window into physical demand from one of the world's largest markets. Is the premium expanding or is it contracting? An expanding premium tells us that buyers in the East are eagerly scooping up physical metal at higher prices than the West. indicating a powerful real-world demand that the paper markets can't ignore. A contracting premium might suggest that demand is cooling off. This divergence between East and West is a major theme right now, creating both volatility and incredible opportunity for those who are paying attention. Third, and this might be the most crucial point of all, are COMEX inventories continuing to bleed. We need to watch the registered stockpiles like a hawk. Every day we see physical metal leaving the vaults. The question is, at what rate? If we see a sustained high rate of physical delivery, especially if it stays near 100% of what's available, then the situation changes dramatically. A squeeze on the physical supply stops being a theoretical concept discussed on forums and becomes a simple matter of math. When the physical metal is gone, it's gone. There's no amount of paper contracts that can conjure it back into existence. This is the structural stress I've been talking about, and it's becoming more visible every single day. So, let's recap what we've just seen. Was this a fundamental collapse in the market? Absolutely not. This was a classic leverage unwind. Over-leveraged positions got wiped out by a sharp, aggressive move. It's a painful but necessary cleansing process in any market. The underlying fundamentals, particularly the story of physical demand versus paper supply, remain stronger than ever. The key takeaway here is that the regional divergence between Eastern and Western markets is creating a fascinating dynamic. It's increasing short-term volatility, but it's also highlighting massive opportunities. The paper market structure, which has dominated price discovery for decades, is under visible and undeniable stress. We are literally witnessing a historic transition in real time, a shift from a paper-driven price to a physical-driven price. I want to know what you're seeing. What charts are you watching? What data points are you tracking? Drop your analysis in the comments below. Let's build a community based on shared knowledge and solid logic, not hype. And a quick, important reminder, always do your own due diligence. This is for educational purposes only. I will never ask you for money. I don't run paid signal groups, and you should be extremely cautious of anyone who does. Your primary job is to protect your capital and stay far away from scams. If you found any value in this breakdown, please consider sharing it with just one other person who you think needs to hear a message of truth over hype. We're all navigating this complex environment together. Thanks for tuning into Boring Currency Live, where we choose logic over noise. Stay sharp, and I'll see you in the next one.